As we're sitting here in winter of 2022 with high inflation and 7% mortgage interest rates, is there going to be a repeat of 2008 market crash? There's a lot of fear and misleading information right now going on with regards to real estate. There are some people that's spreading fear that today's real estate market is going to be like that of 2008. So one reoccurring question that we've been getting from many of our clients right now is, Colin, do you see a repeat of the 2008 market crash coming? In this video, we're going to talk about 3 critical market indicators that shows how today's market in 2022 is much different than that of 2008. Market indicator number 1, comparing foreclosure rate in 2008 versus today in winter of 2022. Foreclosure usually happens when a homeowner is unable to keep up or make their mortgage payment. As indicated by this graph by Adam Data, the amount of homes in foreclosure was close to 10x more in 2009 versus what we're seeing today. The market is very different in 2022 versus 2008 because homeowners in today's market have equity in their homes. Like a recent article by Business Wire where they looked at CoreLogic's data showing that the average homeowner has about $300,000 in equity. So most homeowners in today's current market owe less to their bank compared to the market value of their property. The report also shows that 63% of all homeowners has an average equity of $300,000 on their home, and the other 37% of homeowners have no debt or loan, so the house is completely paid off. Back in 2008, many of those homes that went into foreclosure did not have equity in them. For example, back in 2008, there were many homes that had negative equity where the homeowner would owe the bank $400,000 on that mortgage loan. However, the market value of that exact house was valued significantly less. Sometimes the value was $375 or even $350. And that's where the term underwater or upside down mortgage came from. Essentially, the homeowner owes more on the mortgage loan compared to the market value of the house. Today, the average homeowner has $300,000 of equity like we mentioned, so if they simply can't afford the payment for some reason, there's a possibility of selling the home and getting plenty of cash at closing. Where before in 2008, if you wanted to sell your home, there might have been no equity and the market value was much different than how much you would have owed to the bank. Market indicator number 2 that we really want to take a note is a lending requirement and availability for home loans. Okay, back in 2006, before the real estate crash of 2008, 9, and 10, the mortgage credit availability index was about 868 on the scale. As of today, it's about 102. And so that's 8 times and a half more back then than what we're seeing in today's market. This is one of the biggest correlations to why we're seeing fewer homes in foreclosure in 2022 or 2023 versus 2008. Because back in the early 2000s, the lending requirements were so easy, like banks made it super simple to qualify for a home loan. Basically, giving free access to these poorly underwritten loans that created a false demand in the marketplace back then. Borrowers could qualify back then for a loan even with the worst credit scores. I mean, I remember getting out of college working for the #1 mortgage company at the time in the country. And there were times where our senior manager would approve home loans to borrowers that couldn't even make a $500 car payment, but yet gave them a loan for a $500,000 pre-approval on a house. Yeah, let that sink in for a minute. Even if the borrower had low credit scores, no down payment, 0 asset or money in their bank for reserve, these banks were giving loan programs that would still qualify a potential home buyer for a home loan. One of the most notorious loans of that time was the CISA, otherwise known as the Stated Income Stated Asset Loans, where the borrower can simply state that they make a certain income each month. And the banks did not need to verify if that borrower truly makes that income. Like, just state here that you make $25,000 a month as a business owner selling Pokemon cards that you started yesterday. And we'll just state that you have $100,000 in the bank, aka lie about your mortgage loan application. As the market shifted in 2008, a lot of the borrowers that got these horrible loans found themselves in a predicament where they couldn't afford the mortgage payment. Like some of the subprime loans that went up in payment and the house was now worth less than what they owed to the bank. After 2008, banks started to tighten their lending standards, and over the last 14 years, These lending restrictions has helped prevent a scenario that would repeat 2008 where there's a massive wave of foreclosures. Market indicator number 3, the supplies of homes available. There's about a third amount of homes on the market in 2022 versus 2008. Back in 2006, the number of months of supplies of homes were about 6.5 months. Today, it's about 3. As we're sitting here in winter of 2022, the national months of inventory is around 3 months. Like here in King County, we're looking at around 3.2 months of inventory, which by definition is still technically a seller's market. Historically, 3 to 5 months of inventory is still viewed as a seller's market. 6 months is usually a balance of neutral market, and over 6 months is a buyer's market. And I know what you're thinking, who's buying in this market? We'll answer that in the next video. Again, with combination between minimal foreclosure rate, tight lending regulations, and low months of inventory, these are some of the fundamental difference of today's real estate market versus that of 2008. Once again, thank you so much for viewing this video. If there's any other questions you may have with regards to buying, selling, or investing in real estate in 2022 or even 2023, please feel free to reach out to our team privately. We'd be more than happy to help you and your family with all your real estate and housing needs. Once again, have an amazing week. Stay safe, live well, and take care everybody.